Hello, good morning. You're tuned into ET Now. I'm Anisha Jain. With me is Nikunj Dalmia. It's the day of the monthly options expiry. I'm trying to bat for the Bulls today wearing the green because so far it's not been the case this month so far. We are tracking losses to the tune of almost 3% for the month, and it's the fourth consecutive month that we are likely to see perhaps a red tick as far as the Nifty goes. Having said all of that, for the year as well, the Nifty has been outperforming. The biggest laggard in the month gone by, though, has been IT. And look at the underperformance coming in from the Nifty versus what's happening across the globe. So we are falling alone as far as this month is concerned. The biggest laggard was clearly IT. Autos did not have a great time. They're sitting at 8-month low as far as the Nifty Auto Index is concerned. And media too has been retracting quite a bit. In fact, even if you look at the last 5-day move, we are down almost 1.28%, and for the year we are tracking losses to the tune of 7%, and that compares to over 12% rally that we have seen in the US markets. FI flows, they continue to be tepid, but at least the good news is yesterday with the inflow coming in, that for the month of March they have turned buyers. Whether the momentum sustains or not is something that we'll have to watch out for, because the FI long position is still around 18%. So Nikunj, I have to say that we've been very sideways throughout the month of March so far. Boring range of 16,800, 17,200, and it doesn't look like we're getting out of it.
No, Nisha, you have to look at the big picture, and the big picture is that in the month of March, it was all about global macro concerns, problems in the US banking system, takeover of Credit Suisse by UBS. So what dominated the headlines for global financial markets was not local news flow. There was hardly any disturbing local news flow. It was all about global news flow. And global markets have not fallen apart, but the Indian underperformance continues. FIs have not been rampant sellers, yet benchmark indices and institutional dominated stocks, which is a combination of IT and to some extent banks, they have not really found any large trend per se. Third, you can smell that the markets now are showing signs of fatigue, and there is not a scare, but there is a proper lack of ownership or lack of buying in any of the small and mid cap stocks. So whether it is on the HNI front or on the retail front. So the headline is that India underperformance continues. This would be the fourth month Nifty is all set for a negative close. We are underperforming in a month where global news was the concern, not the local news flow. And more than FI selling, I guess it's a local crowd now which is feeling the heat of volatility, is getting tired, is in no mood to participate, and I think is getting reflected. These are phases in the market, Anisha, where you would say that nobody is really interested in participating. Everyone is asking a very basic question: where is the risk reward ratio? Is it in a debt mutual fund or is it there in paying my home loan? So when there was a trend, which was a smooth trend, which we saw a couple of months after that COVID fall, which in a sense made work from home employees to start adopting trading as the second profession. All that, I guess, has got challenged now.
And clearly that's visible in the volumes. No momentum, no participation, no interest whatsoever, and no interest with respect to how the SGX Nifty is also moving. A very tepid start at what it is suggesting, an up move of 14 points. Remember, overnight, if you look at the cues coming in from the US, they were also pretty sideways. We saw a 40-point downtick for the Dow. There was a bit of an inch up when it comes to the US yields. Remember, the 2-year yield has already spiked over 4%, and even if you look at the 10-year yield, that was around that 3.57 mark. In fact, globally speaking, the other news point that everyone is talking about is crude. Last week it was what, at $71 to the barrel. Suddenly it spiked to the level of $79 now. So quite a bit of rally is what we are seeing sustaining as far as crude is concerned as well. This morning Asia started a tad bit mixed, while Nikkei is showing a gain of almost 115 points. Hang Seng is up a solid 400 points. Let's see where India goes from here, because for now the SGX Nifty is very tepid, just around that 17,000 mark. But as we pointed out, it's the day of the monthly expiry, so let's talk about the F&O rollovers as well. The Nifty rollover stands at around 61%. The 3-month average is 57%, so it's pretty much in line with what we have seen. If you look at the March expiry so far, Bank Nifty has underperformed, though in the last couple of days we have seen a bit of an outperformance from Bank Nifty. But for the expiry month so far, we have seen 1.5% decline for Bank Nifty, while the Bank Nifty was down around 2.5%. The range has been very, very narrow in the sense that 16,800 on the downside to 17,500 on the upside as far as Nifty is concerned. And for Bank Nifty, 38,000 thereabouts to 40,000 is something that we have done. So Nikunj, with respect to the rollover data as well, does it give you a bit of a conviction that perhaps April is going to be different? It's going to be the start of earnings season. We have the MPC meeting in the coming week.
Nisha, what's puzzling me is that we've had 4 months of decline, and 4 months of decline have rarely happened. And when 4 months of decline has happened in the past, that has always happened because of a global event. Whether it was 2008 or when we saw this kind of a decline, when there was an issue in terms of taper tantrum. Now, globally things are not falling apart, which means the selling in the market, I guess, is largely a function of lack of buying or lack of interest. Lack of buying, what drives interest in the market is always performance. And since the performance in the short term has been anemic and India is underperforming, nobody really wants to commit to capital, because trading this market has not been a very gratifying experience. If you are buying into small and mid cap stocks, it's very hard to find winners, because the general trend is that small cap stocks are headed lower, and on a daily basis compulsions of PMS redemption and compulsions of retail unwinding is having a more collateral damage rather than anything else. The interesting bit for me is that Nifty futures for the month of April, we look at that, is still at a premium. Why? Hello. If the disinterest is so high, if the lack of participation is evident, why are Nifty futures trading at such a strong premium, both for the Bank Nifty and the Nifty? So markets are telling you that, look, let's think contra. Maybe it's time to buy the Nifty. 4 months of straight line fall, global cues are set, and April you may actually bounce back. I will not be surprised that if you will get a bounce. Why? Because there is just everybody's on the same side of the boat. Nobody wants to participate. Nobody wants to commit to fresh capital. FI positioning in the F&O market, 90%, very, very negative. FIs have stopped selling in the cash market. The expectations from earnings season is almost zero. And globally, the crisis which was there, so far it appears it's got stemmed. And valuations with each passing day, because you're growing, they're getting more and more reasonable now. So I think we are nearing that end of decline. I think I'm very clear. Now it's a matter of judgment when you want to throw in your ring in the hat, so to speak. B, you may see some more pain, because that could be more not price pain but time pain. But I think we are nearing that part of the market where markets are overdue for a correction. They've gotten correction, consolidation has happened, and now you're getting ready for the next frog leap, so to speak.
Getting ready for the next frog leap, that's the most important thing that the market is watching out for. And we're watching out for what was happening with the Adani Group of companies as well, because yesterday all of those stocks were down anywhere between 4 to 10%. But now there's a clarification coming in from the management. They have strongly refuted news reports on non-repayment of dues and pledge shares. They are saying that they have announced already to the exchanges with respect to what kind of repayments they have done already, as well as the level of the pledge share which has come down. For Adani Green, the pledge position as of 31st December, for instance, was 4.4, which has come down to 3.4. And even for Adani Ports, from 17.3, it's all the way down to 4.7%. So the management is backing that. We have already repaid a huge amount of sum which was due, and even prepaid a lot of it, and the pledge share positioning has also come down. Nikunj, we started off the year suddenly with this bazooka coming in from for the Adani Group, but things were stabilizing for now. But it suddenly feels like there's a cat between the pigeons, and suddenly again the Adani Group of stocks were declining yesterday.
See, Anisha, the sentiment for Adani Group of stocks is fragile. We pretty much know that. But the concerns which in a sense had hit the stock, is that concern getting clarified? The stocks yesterday reacted because of a media house raising a red flag or doing a story which talks about the claims what the Adani Group of companies have had in terms of their pledge position. That is something which is factually incorrect. And that spooked the market, because the markets are nervous. There are no buyers in the Adani Group of stocks. There was one large buyer who came in, and after that we've not seen too much of follow-up buying. But if I'm putting facts on the table, well, the Adani Group has come out and said that the group, I mean, they've come out with a clarification, and they've really said that the report, what a media publication yesterday published, is factually incorrect. So I'm simply reporting facts out. I don't think you will see a very big rally per se after this clarification for Adani Group of stocks, but it is important for us to point out that after that report, Adani Group has come out and they've said that the report, in a sense, or the media house which published this report, factually that is incorrect.
Okay, so hopefully there would be a bit of bounce back on the Adani Group of stocks today. But let's listen into the word from the wise coming in from Lawrence Belanco of CLSA. He says that worse is behind, but probably the benchmark will continue to be sideways, and the range that he's expecting on the Nifty is right from 15,400 on the downside to 20,700 on the upside. Listen in.
Well, our base case is that we're expecting to see further volatility in the trading range that the Nifty's set up, basically from the peak that you made in late 2021. And that range, unfortunately, is fairly wide. We're talking about a 15 to 70% wide trading range, which has provided support around that 15,400 area for the Nifty and resistance up at the 18,600. The positive short-term setup is that we did find support at the 16,700 area on late last week, and we continue to hold that in early trade on. So best case scenario is that we're holding the upper boundary of that trading range. The fact that the Nifty remains trendless would suggest that at least for the next 2 quarters, we're likely to see further relative underperformance if you look at it versus an EM basket at least. Also, we can continue to hold the 16,800 to 18,600. That would be the best case scenario. The weakest scenario would be a break below the 16,800, and that would open the door for a move to the bottom of the range, which comes through at the 15,400 area. The trends are still very positive for the broader market, and we still got upside targets of 20,700 to 20,800. But we have mentioned before, that it's not uncommon for the Nifty to spend a number of months, if not years, trading in a range. I mean, you can go back to the 2010 to 14 scenario that you consolidated the gains of the 2009 lows before you broke out in 2014. And then you saw a similar 12-month period between 2015 and 16 where the market digested the gains following the breakout from 2014. And currently we're pushing on to 16 months of a ranging period, and that could extend for another 6 months at the very least, but it doesn't alter the longer term structure, which remains bullish.
Okay, it's the day of the monthly options expiry, so we'll need the help of our technical experts to wade us through the volatility. We have CA Rudramurthy as well as Naresh Mirani joining us to do just that. Good morning, gentlemen. Naresh, let me start with you. You have the color red, which is surprising me a tad bit, worrying me a tad bit. Is that what you're expecting for the day?
Let's hope the color does not play out in the market. So if we look at the markets, we've been at the same place for the last 10 to 15 sessions. We've not gone anywhere. We've been trying to make that move towards 17,200 or 16,800, but it flops out. So we are still stuck in this range. So till the time we don't get beyond this range, it is difficult to take a new trade. So it's a hold wherein you keep a stop loss at 16,800, get aggressive above 17,200. Also, same is the case globally. Also, the markets have been pretty sideways for the whole world as well. The only thing which we are seeing different in India is the small cap and the mid cap indices have actually hit new 52-week lows. And out there, we are seeing the breadth getting worse. On a comparative basis, it's already closer to 16,400 equivalent of the Nifty. So I think going forward, small caps could bottom out, look oversold in the near term.
So, Naresh, if I had to follow up and ask you, what are the chances you believe that at least in the month of April, we'll see a bit of bounce back? Because, fine, this year has gone back and the next couple of days, perhaps people will be on the sidelines with the financial year end, etc. But what about April? Because are we entering that oversold, territory in a lot of stocks and sectors?
So the other way to look at it is over the last, say, 3 years post the COVID lows, every time the FII short positions have gone to the levels currently where they are, there has been a bounce back. So March could be the place where we've started seeing some bit of covering. So April, it augurs well for the fact that you're highly oversold on the small cap index. And on the Nifty also, we can see a recovery. The case is whether we break 16,800, then make a low and recover, or directly go above 17,200. But at 17,000, the risk reward is shifting more towards the long side only.
Okay, so a bit of a favor towards the long side. Do you concur with the viewer, C. Rudramurthy, or would you believe that perhaps it's still wait and watch, the time correction is not over, so not a sharp bounce back in April?
See, for me, I feel April month, even if you get any bounce back, that will be sold into. We have to understand levels very clearly on Nifty futures. Nifty futures is in this band of 16,800 on the downside, and on the upside 17,350 is now the crucial resistance. But if you watch very closely last 3 days, Nifty futures is trading in a tight band, which is 16,900 on the downside and 17,120 on the upside. So this smaller range which is there, once we give up, then yes, 16,800, and finally if you break 16,800, there is a free fall. So even if you get a bounce, because we are highly oversold at current level, this bounce can go to levels closer to 17,120, 17,230, but I don't see it crossing 17,350. So any bounce will again be sold into is what I see. If this down move has to end, you have to close decisively above 17,350. Also look at Bank Nifty future. Last 3 days, Bank Nifty is just in a tight range of 500 points. If you look at Bank Nifty future, downside is 39,350, the range for last 3 days, and on the upside it is 39,850. So this narrowing of range tells to me that once you get a breakout out of this range, the move will be very sharp and swift. But I feel the move can come most likely more on the downside. Even by chance you get a short covering, or even because we are highly oversold, you get any bounce, that will also be sold into. So I am not bullish. Let us wait for 17,350 to cross to say that this sell on rise market is over.
Okay, being a bit more cautious, believing that the rallies will be sold into, that's the word coming in from Rudramurthy. But let's get stock specific and get in the top recommendations from our experts. Naresh, you go first.
So continue to like the large cap banks. So first is the Buy on Axis Bank, which has corrected well, making a base around 815 to 825 levels. A risk reward trade here, a stop loss at 815 and a target price of 900. Second is the Buy on HDFC Bank, which has clearly held on to that support of 1530, the last cap up zone, and has been relatively outperforming over the last 3-4 sessions. I would expect a small bounce back towards 1650, a stop loss at 1555.
Okay, so continue liking the large banks at this point of time. Rudramurthy, what about you? Stock specific recommendations?
Yeah, I'm picking both sell call. One is Jubilant Food. Look at this stock and chart pattern for last 6 months. From levels closer to 650, there is a one-way fall. And even in a good market, this stock goes down. So these are weaker counters which you can sell and available in futures for you to go short on. Multiple resistances are clearly visible at the range of 450, 460 zone. So any bounce from current level closer to that 450 zone, I'll be taking short position. Look at initial targets of 421. Once it breaks this zone of 415, 420, further slide can be seen on the downside. So a clear positional sell on rise and a positional short call on Jubilant Food. Next one is RBL Bank. Again, in banks, if you see, even last time when I was in your show, I said short banks like Bandhan Bank, RBL Bank, these are all weaker ones. See what happened to yesterday Bandhan Bank, and I won't be surprised if we see very soon even RBL following Bandhan Bank. RBL Bank for me is again a sell on every rise. Look at initial targets of 125 and eventually even 110 and even 2-digit to come on RBL Bank. I'll keep a stop loss of 142 and sell RBL Bank on every rise.
Sell RBL Bank on every rise, that's the word coming in from Rudramurthy. But the other stock which has been coming under pressure of late is Tata Power. From the last 2-3 sessions, we have been seeing that the stock has been on a downtrend. And this morning, there's a note coming in from BNK, wherein they met the management and there are some key important takeaways that we need to watch out for. First up is on the Mundra power plant itself, wherein they highlight that the company have receivables to the tune of 1,800 crore from that power plant. And as a result of that, they have shut down the unit till all dues are cleared. Remember, this is something which they had done earlier as well. But now, given the fact Section 11 had been imposed and the government had mandated all the import-based power plants to continue producing power, and the excess could have been sold in the open market, this is an interesting move coming in. And even if you look at the bargaining power coming in for Tata Power, that expected to go up on account of Section 11. The supplementary PPA has been in the works for a long time now. We were hopeful it will happen by the month of March, but clearly they seem to have missed the timeline on that one. Separately, on the Indonesian ventures as well, they say with the slight tempering of the coal prices, it's going to be better for the company. The profitability of the mining business will get better because the royalty arrangement is such with the Indonesian government that a bit of a lower price of coal will be actually profitable. As a result of all of this, BNK has actually cut their target price from 262 to 252, but they're expecting that the medium-term outlook will be better as in the coming months because of the summer heat. They're expecting a big spike in the demand as far as electricity is concerned. In fact, we spoke with the management of Tata Power recently and began by asking them the situation of the Mundra power plant. Listen into what they told us.
So in Mumbai, we never have load shedding, and Mumbai is a city which has most reliable supply in India. We are expecting around 4,000 megawatt of peak demand in Mumbai. For Tata Power Mumbai, we are expecting around 1,000 megawatt. We have a power arrangement of around 1,400 megawatts, so we don't expect any shortage of power. Mumbai is lucky in a way that the entire network is underground. Entire network has a redundancy. On the top of that, you have latest technologies deployed, so if there is a fault from one side, supply is restored from other side. That is why you don't feel any outage in Mumbai now. If you see there is no outage, and if you see that we have surplus power even in summer, we don't see any issue in summer for Mumbaikars. In addition to that, the growth in demand, if you see, Mumbai per capita consumption is around 2,000 plus, whereas India per capita consumption is around 1,200. So the demand growth in Mumbai will be relatively less. So whereas the India can have a demand growth of around 10% in terms of consumption, Mumbai is not going to have more than even 5%. That is what our projections is.
We are in discussions with all the stakeholders, including Government of India, and we do expect that this will happen sooner than later. So let's hope that we can conclude a mutually acceptable arrangement, acceptable to all the procurers as well as to us and the government, so that the plant can operate at full capacity and provide competitive rate power to the consumers.
So in terms of profitability and under recoveries, can you comment a little bit on that since this Mundra and PPA will soon be fruitful after post the announcement comes in? A word on that.
At this stage, we are in silent period and we would not be able to give any details. So once our results are declared in the month of May, we will be able to share more details.
So a word on the renewables business. How do you expect it to grow? What is the capacity expansion that you have? What's the outlook like for this year?
So our renewable business is doing very good. As you know that...
All right, cigarette prices have set to go higher. Now, we've not got any official intimation from ITC, but there are channel checks which are indicating, and some of the brokerages have come out with indications, reports that the channel checks are indicating that ITC has taken a price hike. Morgan Stanley channel checks, JP Morgan channel checks are indicating that cigarette prices have been hiked. Now, Sharad, is this across the board or one specific category?
Well, right now in the beginning, it's for a specific category, and Morgan Stanley's channel checks are actually suggesting a price hike of almost 50 paise per stick. Now, this is coming for the Gold Flake King Size segment, but going ahead, also they are going to implement it across the portfolio. But currently for the Gold Flake King Size segment, it's around a 3% price increase, and also similar price interventions are coming for the Bristol brand. That is also almost 50 paise per stick. Now, the current hike currently is implying almost 1% price hike across its weighted average portfolio, but going ahead, Of course, it's expected that in the coming weeks, this will be the price hike will be taken across portfolios and across the markets. Now, because of that, we can expect at least 6% total price increase on an overall portfolio level as well. But do remember, these price hikes have been actually taken because in this budget there was a tax hike was being undertaken, and over the last 2 years itself, if we see, there was no major price hikes or tax hikes coming in. So because of that, the entire volume segment will also be impacted. But do remember, the overall it's a very small price hike, and going ahead, the Morgan Stanley is expecting a 4% increase in the volumes as well as 4% increase in the EBITDA margins as well.
Thank you so much for joining us. So ITC is something that we'll watch out for, and there have been some comments coming in from Mr. Puri as well that FY24 is expected to be better. The worst of inflation is behind, and they're hopeful that there will be a bit of a rural recovery in FY24. So we are watching out for all of that as well. But there's a lot happening in the world of metals as well, and Vedanta specifically is in focus because it's declared the 5th interim dividend to the tune of 20.50 rupees per equity share. This means that for the entire year FY23, they have paid a total dividend of whopping 37,731 crores. Let's go across to Asesha to understand the history better. Hi, Asesha.
Yes, absolutely. So Vedanta has declared 5th interim dividend for the current financial year to the tune of 20.5 rupees per share, which at the current market price entails a dividend yield of about 7.5%. This will entail an outflow of about 7,621 crores for the company. Remember, for the full financial year, Vedanta has now declared a total dividend of 101.5 rupees per share, which is much more than the total dividend that the company had declared in the previous financial year, which stood at about 45 rupees per share. Remember, this will help Vedanta Resources repay its debt obligations, which has been a concern over the last couple of months. Vedanta Resources holds about 69.7% stake in the company, and the company will receive about 5,300 crores from the 5th interim dividend that Vedanta has repaid. Remember, Vedanta Resources had plans of reducing debt by $4 billion over a period of 3 years, and it has already repaid $2 billion in the first year itself, that is in the current financial year FY22-23. The company has also reiterated that it will continue deleveraging. Important to note that company now has a total liability of about $7.7 billion US, and out of that it has maturities to the tune of $3 billion US in FY24 itself. Apart from this, the CFO of the company has also resigned. Mr. Ajay Goel has resigned from the post of acting MD and CEO of the company. This will be effective from 9th of April, and the company has said that it will be announcing the details of the successor in the due course. Today, of course, the stock will be in focus because the company has declared 5th interim dividend to the tune of 20.5 rupees per share.
This is just those, one of those, mystery companies in terms of capital allocation. Here you can clearly make out that there is a real desperation by the promoter, because the promoter has got debt obligations which they really need to be fulfilled, and in that process, large part of the company now, large part of the cash is now going to be moving in part of dividend. Now, last couple of years, Vedanta has had a strong dividend history, but last couple of years, commodity markets also have been in a bull run. If commodity markets are not in this kind of a bull run, and given that Vedanta is there in oil, Vedanta is in metals, Vedanta is there in both industrial and non-industrial metals, if the cycle is not that favorable, what happens to the dividend? What happens to cash flow? If such a large dividend payout, which has happened, and now the total dividend stands at about 100 rupees for FY22, FY23, what happens to the future capex, cash flows? If the cash flows are not strong, and see, giving this kind of a dividend, at least now that dividend is taxable at the end of the shareholder or receiver, may not be the most futile, may not be the best idea in order to really generate wealth even for minority shareholders. So I don't think because there is a fat dividend, the stock in a sense will get re-rated because of this. Of course, the price adjustment will happen because of the dividend payout, but what happens after that? What happens to FY24? What happens to FY25? Imagine if the commodity cycle is not that favorable. That is something which is worth reconsidering. Rudramurthy, what's your view on Vedanta?
Nikunj, when I see the charts of Vedanta, definitely from levels of 300, 310, there has been clear selling. And even if you just get any bounce on this stock, which can take to levels closer to, let us say, 285, again, those zones have multiple resistance. So I am not in a camp to buy Vedanta. Rather, I will sell on any bounce to levels closer to 285. Last support for this stock is at around 255. If it breaks 255, steeper fall can be seen on Vedanta. So I want to sell on rise. Levels closer to 285 will be a good level to short Vedanta, or you short from current level and on rise to 285 sell further and look at targets initially at 255, below that free fall.
The word coming in as far as where Vedanta stacks up on a technical basis, but let's go back to Asesha to understand what's the latest news flow as far as Jindal Stainless is concerned. They made a decently large acquisition of 1,300 crores. Asesha, explain to us which is this acquired company and what does it do to the company's strength with respect to products and revenue accretion.
Well, yes, absolutely. Jindal Stainless has entered into an agreement with New Yaking Pte, which is a subsidiary of Xinjiang Group, to acquire 49% stake in the company for about 1,300 crore rupees. This is for investment in development, construction and operation of nickel pig iron smelter in Indonesia. Remember, nickel is the main raw material for stainless, and that is how it will help the company. Consideration will be paid in tranches over a period of 2 years. Facility is expected to be commissioned over a period of 2 years, and it will have an annual production capacity of 2 lakh metric tons. Nuvama has come out with a report on this particular acquisition that has been done by Jindal Stainless, where they say that the deal looks pretty attractive with low investment, and the deal has a short payback period of just 3 to 4 years. They say EBITDA contributions could stand at about 9 to 10% of the total EBITDA by FY26, and the deal, however, could reduce the pace of deleveraging of the company. It will, despite that, it will add a new stream of revenue. For now, the Nuvama has maintained its buy rating on the stock with a target price of 346 rupees per share. So on the back of this note that has come in, and on the back of big acquisition which Nuvama believes will be value accretive come FY26, this one will be in focus today.
Okay, so a thumbs up coming in from Nuvama saying that it's a good investment with a small payback period and likely to have a good amount of upside for the company. So Jindal Stainless will be in focus. But let's move on and get you some more fundamental ideas. This one is coming in from Sanjeev Bhasin.
SW Solar is the largest EPC player in the world. It is the sole agent for providing EPC and MEP for any solar panel and PVs. And Reliance Energy now has a 40% stake. I just had a conversation some time back with the management. They had an order book of 800 crore till last year. This year they are executing 4,000 crore. And by next year, it can even touch 10,000 crore. They have a margin of 11 to 12%. So you can imagine the bandwidth this stock has to create wealth. It is just an 18 crore equity. Reliance Energy owns more than 40%. And if you do your homework and sit still for 1 year, I can guarantee you this year it will be a double. Wanted to pick particular stocks in your portfolio, then I think stick with the large caps. Dr. Reddy and Sun are two large picks. Lupin has always flattered to deceive, but now the management seems very keen on increasing market share. Their generic pricing are improving, and I think they've been through a lot of the problems. So at 700, I think that gives you a very good risk reward.
Now, as you walk into trade this morning, what amazes me is that if I look at the nature of the market, now the problem this month has been global. SVB, Credit Suisse, regional banks having cash issues. So the nervousness is actually global. And despite that, global markets have not fallen flat. But Indian markets, well, the downward spiral continues. Nifty has underperformed. IT stocks have underperformed. FIs, they continue to sell the market. Now, if the problem is global, why are Indian markets underperforming? I mean, the whole idea of investing in Indian markets was that India is decoupled and it is like the bright star. And when there is a problem in the rest of the world, why is this bright star suddenly losing its shine? And Rahul Shah, that is my question. ये problem अगर global है, तो local markets underperform क्यों कर रहे हैं?
Hi, good morning. I think we've seen by and large always that whenever the global underperforms, we always tend to underperform. And let's not forget that in last year, we outperformed vis-a-vis the global markets and we continue to trade at premium. So I think if you look at it when we started this year in Jan, The trade for the most of the institutional investors was sell in India and move to China, and the Chinese markets saw good rally. Now again, the trade has started reversing. So I think slowly and steadily we will see that comeback in Indian markets, and most importantly, when we see the market discounts the future things. So we've been seeing that IT, what has happened, or banking also, when you have a global crisis, the local things remain very, very strong and intact. So I feel that this is a near-term in nature. So when we start Q4 earnings start coming from the second week of April or so, and maybe the quarterly updates from the most of the financial companies. So then we will see some that the rallies coming back to the markets, and we'll see the the upsides again starting flowing into it. So I think near term this remains always a challenge whenever we see a global wherever there's a problem, and we tend to underperform, and then maybe the things will start.
There's a report coming from Emphasis, no exposure to Silvergate Capital either as a client or as a banker. And this is, almost all the IT companies have come out and have said that, look, we don't have a direct or indirect association or a business relationship with any of the banks where, in a sense, right now, there have been asset liability mismatches, whether it is Signature Bank or SVB. I'm not so sure what the Credit Suisse connection is. Frankly, Anisha, nobody has come out and has said that, look, I've got no connection with Credit Suisse or UBS.
Because they all have
connections there,
and Deutsche Bank, so they can't say that. But at least it's getting cleared up with the UBS takeover. So I don't think
business will slow down, Anisha.
Yeah.
See, when a takeover happens, the staff would be merged, processes would be merged, and that's an ongoing process. So UBS tech team and when the Credit Suisse tech team, they would come together, there would be similarities and there would be platform interlinking. That's a complete process. What happened after Lehman, you have to realize that the IT industry went into a contraction mode. So IT spending was cut down. Right now, the IT spending may not be cut down, but everybody, in a sense, who was happy to pay that extra dollar to to outsource much more, because 3 years of total technology adaptation had to happen in 1 year. 1 year had to happen in 3 months. 3 months had to happen in 7 days. All that is over. Yeah. Just think about it. A year ago, we were talking about moonlighting. Now we're talking about layoff. How the world has changed. And why do we blame commodity companies for being cyclical? Just think about IT companies who are in the business of running artificial intelligence. They're not able to predict their own models. From moonlighting to layoffs, what's going on?
Yeah, I know, from that
And when
mass
the sun is
resignations
not...
to mass layoffs is what has happened in a short cycle of less than 12 months. I mean, the cycles itself are getting so narrower. So, very interesting.
They overcommitted, Anisha. I think they overcommitted. Everybody got wrong in terms of understanding the whole IT cycle. And it's only when the sun is shining bright we talk about moonlighting. When the sun is going down, nobody talks about moonlighting.
Oh, well, yes, and that's what BofA Securities is actually also saying on Q4 of the IT companies. They're saying it's going to be pointing towards an incremental slowdown. Uncertainty levels are quite high when it comes to financial services and high-tech, and that's one thing that they're going to watch out for. It's going to be a soft quarter for Tech Mahindra and Wipro, and that's why they have an underperform rating on the same. However, as far as HCL is concerned, they are positive, given the entire, risk-reward play, and neutral on TCS and Infosys. Company-wise, they say TCS, the decent momentum will continue. So they're not worried there. They're worried about Tech Mahindra because it has high exposure to telecom, high-tech, BFSI. All of the three verticals have been coming under pressure. Wipro, wherein they are expecting that the revenue growth could be towards the lower end of the guided band. And for Infosys as well, BFSI vertical is something that they believe is going to point to a slowdown. Rahul, your take on the IT sector as a whole? Is it time to probably deploy if you're a long-term investor, or probably there are better levels coming, so just wait and keep your powder dry?
I think the most important thing, if you look at in IT companies, is I think obviously their focus, the customer remains on a BFSI segment. And whenever we see a slowdown over there, obviously the IT earnings is going to get impacted. So if you talk about the short-term momentum, and when we had the channel checks with most of the large and mid-size of IT companies, obviously remains that first half would remain a challenging for the most of the IT companies. But the structural demand remains strong. So if you ask me that first 2 quarters, yes, it might remain slow, and maybe the third and the fourth quarter, the demand and the thing should be back on track. So if you ask me the prices and the stocks which have fallen in last 1 year and so, TCS, Infosys, HCL Tech remain a strong bet from our side in this kind of an environment. And just to give you a perspective, in this kind of fall, if we see when the markets have fallen 5-6% from the near term, and where we see the IT sectors just falling 2% over the indices wise. Now, if we get TCS and Infosys at 20 times earnings, and the company with ROE of 47% for TCS and 38% for Infy, then I think this remains a pretty decent bet for a long-term investor. Yes, the near term might be challenging, but I think if you look a little bit longer horizon, then yes, all this large cap plays looks very attractive from here.
SGX is indicating that we may start above 17,000. Okay. Naresh, I come in the morning and I say SGX is telling us that we may start 50 points higher. Rest of the day, we just get tossed around here and there. And all we do is that either 100 points up or 100 points down. You go to 17,200, supply comes there. You go to 16,800, 16,850, buyers, they come there. It's been this 4-month range now. When have we seen such long ranges in the past, Naresh?
So, see, there are two times where we can actually compare it to the current scenario. One is the 2015 to 16 period, wherein we continued to stay in a sideways range between 9,000 to 8,000 Nifty. Then it was 2011 to 2014, which was almost 3 years of range-bound moves. So we've seen that happen before. We've already spent 18 months. We've not seen more than 3 years of such a range-bound move. So out here, if we remove out the volatility in that period, which was the Russia-Ukraine crisis, the whole 18 months, you could actually say we have been at that 17,000 mark. The interim moves to 15,200 and 18,800. But if you look at the average prices, we've been at 17,500. So the more important point out here is that the number of months which have passed. So today you have the Nifty at the same place where it was 18 months back. The small cap index at the same place it was 18 to 20 months back. So eventually it's a time-wise correction which would resolve itself. So my view is we've done a good part of the correction and now we start watching out for things to get better going forward.
That's the Nifty for you. Now, as you walk into trade this morning, I would also like to point out that the FI number yesterday was not net seller. They were net buyers. Yes. No large block deals yesterday.
There was one wherein Kalyan happened, but then there was an FIS seller as well with respect to Warburg Pincus. So if at all, it would have been balanced. So
and I think PI, the private equity investment does not go in the FI kitty. It's a portfolio number which we look at, because if there is a seller there, which is a private equity, I think, and if there is if there are clutch of buyers, so I don't think that really gets captured in the data. My limited point here is that why are markets down? Problems in the world. Why are markets down? FIs are selling. Why are markets down? Well, the retail is not active. FIs have been net buyers this year. S&P is positive in the month of March. So the two factors, which in a sense are the overarching factors, which are supposed to be bringing the markets down, they are not that bad. Global markets have not caved in, and FIs net at a net number, which is what we look at. At a net number, they are buyers. So Rahul, FIs have turned net buyers. Domestic institutional investors are net buyers. Global markets are solid. So bhai bech kaun raha hai? That's a question I ask everybody. Who is the seller? Motilal Oswal is not a seller. See, Motilal Oswal is not a seller, I know it.
So I feel most important thing is, I think if you look at it last 3 months, if you look at or maybe a little bit longer. So we have seen that I think the mid-size segment, mid-caps have been underperformed. And I think the basic market strength was also from the retail side. And I think the retail has seen some kind of an impact, and that volumes have shifted more towards the option side. So I think that's one of the thing where we feel that I think still the time the markets have that broad base or a bull market kind of a rally, the markets might remain a slack. And after a fearful selling, if we look at it, and same just to give a perspective, 8% sell-off or 8% plus sell-off in the banking index, which was a star performer in last few quarters if you look at it. PSU banks, which have fallen an average 15 to 20% and more in some cases from their recent times. So I think where the structural flow was, and from there where we saw kind of a sell-off, I think this is what we need to understand that. So I think in near term, I think it's just a time wise. We have to look at it. I think, as I said, that in it, maybe a couple of weeks later when we see the earnings coming back, so I think then people will realize and then we'll see some kind of momentum again picking up in the markets.
I wanted your take regarding the Adani Group of companies. So yesterday, of course, there was that knee-jerk reaction. Today, there's a clarification from the company. But structurally and fundamentally speaking, would you be a buyer or at least recommend a buy on the likes of, let's say, Adani Ports, ACC, Ambuja, some of these better companies with stronger balance sheets?
Officially, we don't cover obviously the Adani as a group, but I think yes, as you mentioned, that I think ACC and Ambuja, if you ask me, but I think Ambuja remains a strong back in the entire cement sector, one of the preferred pick in the cement sector. And if you look at it, that Q3 and Q4 are usually the better times for the cement companies. So I think the numbers were decent in Q3 for Ambuja. I think Q4 also, as we do the channel checks, I think the cement should remain stronger in Q4 as well. And then we see the oil prices cooling off, looking for price coming down. So I think this will help them into increasing the margins. And most importantly, if they look at it, the prices are not corrected. So I think this will augur well for the margin as well. So I think if you have to look at it in this crisis, if we can get, then I think Ambuja remains a preferred bet among the entire Adani basket.
Okay. Now what we've been looking at is the fact that 4 months, it's very rare that markets have fallen for 4 months on the trot. Let's look at instances in this decade and in the previous decade. What have been the instances where Nifty has fallen for 4 months on the trot? Now remember, 4 months on the trot, down, 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 down. It has rarely happened. It has happened in 1996, really? It has happened in 1998. It has happened in 2001. What happened in 2001? 9/11. There was 9/11. And then obviously markets would fall. But the problem is that when markets have fallen for 4 months on the trot now, it has been largely because of global financial crisis. It is largely because of a real collapse of the system. Even in COVID, markets did not fall for 4 months on the trot now. Then the next instance is 2001, when markets fell for 4 months on the trot. That's also because of the TMT bubble which got pricked, and you had 9/11. So there were serious global crises when markets have fallen for more than 3 months. And Rahul, that is my point. Our market's telling us something. I'm not sounding bearish, I'm not trying to raise an alarm bell here, but data is data. When markets have fallen historically for 4 months on the trot now, that is only because of a global event like a 9/11 or a TMT bubble. Markets have not fallen 4 months on the trot now, even in 2020 when the COVID crisis had hit us.
Correct. You rightly pointed out, I think the data suggests the data is right and it is not wrong. And I think obviously you've done a good research on this. So my sense is that I think obviously we've seen a global crisis in terms of the banking universe in the globe. But I think most importantly, if you look at, they have resolved also very quick. It's not been a saga like Lehman or something which was dead for a while and then it came up. And secondly, most importantly, if you look at it, the kind of leverage what we had in 2008 in the balance sheet of all those banks, and if we compare, they were like, say, for just to give a perspective, when the leverage was 1:30 or something kind of that. And when we compare here right now, the leverage is pretty low. So I feel that things have sorted, and I think it takes time to get back the confidence into the markets. So I feel that obviously the sectors which has we've seen a sell-off, and plus secondly, what most important is, I think the fear in the mind of the investors, or if we look at it, and when we have seen that in past, in such kind of where the markets have tumbled more than 25-30% on index side post such kind of an event. So I think that fear in the mind which is dragging it down. And then if we look at it, when we talk about it, that banking crisis came in this last 1 month and a half. Before that, during the budget time, we had a crisis because of the Adani stocks selling, and because of that, I think we've seen a decent sell-off in the entire market. So I think these are also, a couple of things which we have to remain as a local, not a global. So I feel that things will sort it out as we see and as the time sort it.
Okay, that's the word coming in as far as where the market setup is and what the fourth month decline could likely mean for the markets going forward. But today there's also going to be an impact on flows because of NSCI indices rebalancing. Let's go across to Harsh to understand which are the top candidates which are likely to see some inflows and which are the ones which are likely seeing outflows. Harsh.
Well, yes, the NSE rebalancing, and I'll talk about the net flows with regard to some of these rebalancings that will happen. Page Industries will see a $35 million inflow, as you can see on your screen. Can Bank will see a 31 million and SBI will see a 28 million. But far more relevant is the flow to average daily volume. And that for Page Industries will be very close to 4 times. For SBI will be, very minor, 0.3 times. But for Can Bank will be 1.1 and for ABB will be 2. So keep an eye out on those. In terms of outflows as well, we're seeing Reliance with 42 million expected outflow. Infosys with 39 million as a result of the rebalancing. Emphasis will see 27 million, Bandhan Bank 25 million and M&M 24. We've seen some pressure on those stocks in any case. And what we're also seeing in terms of flows versus average daily volume, it's 1.4 times for Bandhan and 2 times for Emphasis. So keep an eye out on some of those.
Okay. All right. Harsh, thanks a lot for that. Manoj Muralidharan joins us now. Manoj, good morning. Thank you for joining us. We are debating that when was the last time Nifty fell 4 months on the trot now. And looking at the SGX, it's going to be 4 months today after a gap of nearly 20 years. My question is that if the underlying market mood is sticky and bearish, I hate to use the word bearish, but I think that's the right word, then why are Nifty futures trading at a premium? The minute I say Nifty futures premium, I don't have to even finish the question. Now let's hear the answer.
Yeah, good morning, Nikunj. That's an interesting question. Nikunj, there is a correlation which happens between the debt market and the Indian equity markets. I'm sure we all know that. And interest rate is a subjective of the debt market. So if you see almost 2020, the first quarter onward, we had seen huge debt outflows, which is happening in the Indian market. And obviously, the equity market is following the same because we see the banks and the financial, which is a good 32% of your Nifty gets affected. And we see the money coming out of the equity as a hedge as well. But of lately, if I might say that, at least in the last 3 to 4 months, the last 2 months, we have seen some debt inflow, if not much, 6,000 odd crores. So there is a possibility that this outflow which is happening into the equity markets, if I'm not mistaken, FY23 has taken out more than 1,90,000 odd crores from the Indian equity market. So we would see that curtailing eventually. Now, to answer your question as to why the Nifty future is in a premium, it is in a premium, I guess, since October series because those 20-22% of the FIs which classify as P notes, they usually use or select an instrument which gives them fast trades. So if you see, ideally after 2018 onward, we have seen that participation come down. They used to be a good 20-28%, which has actually fallen down to 14 to 16%. And they use more of index options. Now, there is a correlation between your Nifty futures and Nifty options. So we are not really getting into the math there. But that simply says that when you have a premium, let's say in terms of points, which is more than an 80 to 90 odd points, they prefer index options as an instrument to use this strategy and make money, which usually happens toward the month, especially during your expiry time. So to answer your question, from October onward, there is a switch in the instrument which is happening, which also is a derivative of cost of carry, which is nothing but that the additional premium that you pay to carry a position from month on month. So if you see, that is exactly one of the reasons why, despite so much correction, the India VIX has not really gone beyond a 2021. Ideally, from 18,600 to the low of 16,400 that we made, we should have actually crossed a 26% in terms of VIX as well, which is still at 15 to 16 if you see, because huge amount of options selling is where the money is being made. So I believe that the first indication is the Nifty future premium would trim down to a good 40-45 points. That would be the first indication that we are seeing money shift to this instrument, and then possibly the Nifty might make a base, and we might see some base building happening with a range bound mode in the Nifty.
Okay. So do you think it makes sense to chance your arm and roll over your Nifty long positions? Or it may not be a great idea because premium is there?
Nikunj, the interesting part is, I guess since 2017-18, there is a beautiful pair relation which goes on between your Bank Nifty and Nifty, because the Fin Nifty was introduced off lately, let's say a good 6 or 8 months. So this pair trade, and if you remember the HDFC event which happened in April, and we saw the culmination of that in December, the Bank Nifty futures positioning was a good 30 lakhs and above. So on an average, it used to be 18 to 20 odd lakhs. So this additional 30% positioning that you see in the Bank Nifty usually has an event to carry. Now, even in this series, if you look into the April last 10 to 12 days, the positioning has already been taken on the long side for the April series. So I'm afraid that this is not a time to short the market, especially because if more than one third of your index is biased to a positive, trend, and if there is a shortcoming coming in, then it makes sense that the Bank Nifty might rule or maybe trade the Nifty in the positive side. So rolling Nifty, let's say we give it a 200 odd points. Once we see a Nifty closing above 17,200, certainly roll your positions. Now, if it is long position, obviously the 100 points premium, like you mentioned, does not really help. Unlike if it's a short position, you get that advantage of that. So wait for a closing of 17,200 and above, because once we close above that, the Bank Nifty has got enough potential inside it. With that good 32 odd lakhs of positioning that we see, we might get a good 1,400 to 1,600 points. To answer your question, should you roll the Nifty futures long? As of now, wait for 17,200. But if you're Bank Nifty, certainly roll it all with a stop loss of, let's say, 38,500, and the possible target can be 40,200 to 40,500.
Okay, Manoj, appreciate your time and so glad you could join us. Rahul Shah, more than 50% of the small cap stocks are down more than 65% from the 52-week high. If this is not a bear market, then what is a bear market?
So I think, as you rightly pointed out, I think a lot of stocks have hit their 52-week low, and obviously the stocks have come down. So if I come back to, there would be a lot of stocks, small and mid-size, one should look at cherry picking at this point of time. But when the question comes about the bear markets, if you look at it, it's just 3 months away from where we saw that, the markets from where it has stumbled. So my sense is I would not accept it in terms of a bear market, but yes, good correction in a lot of stocks and lack of interest from the investor side, which is where we've seen that the stocks tumbling down. And predominantly, I think the HNIs and the retailers are usually involved in in a lot of interest we see in terms of small and mid cap stocks. And obviously, because of the large global things, I think that interest has just been, they postponed their investment at this juncture. So that's why we've seen been selling in the stocks. So, but I think the select baskets would be a good opportunity to get into all the small and mid caps at this juncture.
Rahul, what's your take on autos? Because just at the end of the week, we'll get the auto sales data, and it looks like that the entire story has been derailed a tad bit, whether it's a worry with respect to El Nino or the discretionary spend, etc., going down. But there seems to be some fizzle which is out of the system.
As you rightly pointed out, and what we also did our channel checks, and we found a couple of interesting facts. That I think if you look at it, the sector-wise, like say, for example, to start with, say, two-wheelers and four-wheelers, and I think two-wheelers and four-wheelers, what we feel is that I think the major impact in terms of the unseasonal rainfall, what we saw in this last month or so, and in this month. That's also one of the reasons where we saw the kind of, the demand getting muted from this sector. Secondly, I think in spite of being a festive season, usually we see this kind of momentum coming back in this year. But this year, it was a flattish kind of for the four-wheelers. And two-wheelers also, as I pointed out, because of the rainfall. And obviously the tractors also, for the same reason, what we saw, that the tractors seems like to be a major degrowth coming up for the current month. Whereas passenger vehicle remains flattish, or maybe when we talk about two-wheeler would be 4 to 6% kind of a growth, nothing much beyond that. And interestingly, I think commercial vehicles looks interesting, and I think that sector, there we can see the safest version coming up in this. So we see that the growth coming up in commercial vehicle, the cycle remains intact. So I think if you have to evaluate all the auto play, the stocks from here, then I think commercial vehicle would remain a top bet, understanding this channel checks from what we get.
A lot of concerns have been raised that the changes in the finance bill could have an aggregate impact on the debt mutual funds, which means NBFCs and corporates who are borrowing from debt mutual fund, they will have to shell out more. And NBFC stocks, especially in last 2 or 3 trading sessions, they've come down. Do you think that connection is slightly far-fetched?
I don't think so. That would be, very much impactful. Yes, it will impact for the few of the companies. But I think in a by and large, I don't think so. The larger NBFCs like Bajaj or TP Capital or Chola or so on, I don't think so. This will impact much for them. But it could be a near-term challenges, and I think that things will back into the play. So I don't see major impact coming up into because of this, at least in terms of the earnings in near term.
Rahul, I just want to come back to the points that you were making in autos. While you did talk about sectorally, what are the channel checks suggesting to you? But stock-specific action, M&M was, of course, a star of last year. But now there seems to be positive murmurs about, the other companies as well. In two-wheeler, for instance, Bajaj Auto has got a thumbs up this morning from a brokerage. There were talks of other companies like Tata Motors, etc., also trying to gain further market share. Your take of what could be the star performer, if at all, in 2023 from the auto space?
As you rightly pointed, I think M&M for two reasons. I think the tractors volume is showing a good decline, so I think that's one of the things. Second, passenger vehicle also is showing some kind of a flattish, where we saw last 2 years being a good demand, and from there where we have seen a flattish kind of a growth in the passenger vehicle space. So I feel that is also one of the reasons. So, but now coming back to the stock specific, then I think I would remain in something like say Ashok Leyland, which I mentioned that I think commercial vehicle cycle will not get impacted, and I think looks like that demand will continue for them. So I feel that Ashok Leyland remains a top bet in my mind, and if somebody has to play, then I think the premium segment, like I think that Aisha in two-wheeler space remains top bets. And thirdly, I think Maruti, I think if we look at it, I think the stock has been, the performer only in last 6 months, and then a lot of gains have been also given up. But I think that remains a strong bet in passenger vehicles with the launch of the 2 new variants. I think the bookings have been good, the Jimny and Forex. So both of them, I think we've seen that 40,000 plus kind of a booking in this segment. So I think that consistency of earning with a strong balance sheet. So I think Maruti also remains one of the preferred bet from the autos.
Okay, I'm going to shift gears and literally shift gears and move to tech. Suresh, 9% down approximately for the IT index in last 4 months.
So, if you look at the whole IT basket, we have started seeing a lot of differentiation in terms of price moves. We have some stocks like Persistent, which went up and hit a new all-time high. A KPIT Tech in small cap continues to do well. A Sonata, which went up to make a 52-week high. And then you have the previous outperformers like Wipro, which continues to make 52-week low. We are seeing a base formation in a Tech Mahindra or a LTI Mindtree. So overall, every stock chart in the IT basket is looking very, very different. So you have an emphasis making new 52-week lows. So out here, the large caps have corrected also. So right now at 3,100 to 3,000, TCS has corrected well from the recent highs. Infosys back to the previous lows. So out here, watching out for a reversal signal in both of them. Those could be bounce back candidates. And in the small cap, mid cap, continue to look out for Tech Mahindra as well as a LTI Mindtree where a base formation is stronger.
That's a take coming in on the tech sector. But Rudramurthy, what about the entire infrastructure sector? Because just towards the end of the year, we usually see a momentum, and next year is, of course, the election year. So do you think for the next couple of months, it's a good bet to be in some of these infra names?
Yeah, definitely. Yes, if someone wants to take stocks for their investment portfolio and you want to pick some of these stocks, yes, it can be good. But however, all the moves which are coming for short term are getting fizzled out. For example, let us say I look at stock like JMR Infra. From that strong base of around 37, made a move towards 42, 43, had fundamental news of further additional stake from QIP, all that, and again from that resistance of 43 back to those levels of 37. Unless you have a longer time frame and you want to buy stocks for investment, you have that 3 to 5 year kind of a view, yes, then you might pick stocks from infra. Even IRB Infra, if I see, the same story there. So if you have that longer time frame gone for shorter term trading or for momentum buying, I will still avoid infra.
Okay, so the shorter term trend is not as exciting for the infra companies, but just a word on IRB infrastructure. Remember, that will be in focus today on account of the hike coming in for the Mumbai-Pune Expressway toll by the 18%. So that's a big, hike coming in. We'll have to pay more, but at least it's good news coming in for IRB infrastructure. But let's get some of the other mid-cap strategies also out of the way for our technical experts. Naresh, what are the top mid-cap bets?
So that's a buy on Mahanagar Gas, MGL, one of the few stocks which has held on in the current market, as well as after making that big breakout move with very large volumes. We did see a fade off of the move. We went back towards the 845, 850 mark and has recovered in the 945 to 950 mark and has recovered in the last two sessions, making a flag formation wherein it would have a fresh breakout about 1000 levels. So preempting a buy here with a stop loss at 960 and a target price of 1100.
What about you, Rudramurthy? What are your top mid-cap bets this morning?
Yeah, see, if you look at mid-cap index, either you look at mid-cap Nifty 150 or even Nifty mid-cap, small-cap 400, most crucial supports are broken. For me, it's a matter of time. Index will also turn down. Might be we are waiting for April expiry. But if you want to pick some good stocks, yes, one such stock is CSB Bank. So for me, CSB Bank has made this strong support area at around 220 zone. And from those areas, multiple times it has bounced with support from volume. So for me, CSB Bank is a buy. So I want to buy this stock for an initial target of 280 rupees. Eventually, even 350 can come. Have a stop loss of 230 for this long call.
Okay, so that's the take coming in as far as the top mid-cap recommendations is concerned. But let's